Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Let's see, just going to make a quick adjustment there. Yeah, a lot of stuff happening all the time. Just the speed is faster and faster. Pretty difficult to keep up with, but that's the job. So, hey, if you have a question today, I'm actually live in the studio. You can call 216-901-0945, 216-901-0945. I'd be glad to try to answer any questions that you might have. We're going to be talking a little bit about the economy today, not just in America, but all over the world, since we are more a worldwide economy now than ever. And it's always been that way, incidentally, even in the 1700s. A lot of what went on in Europe had a big impact over here. And a lot of what they did, a lot of what we did had a big impact there. But we're gonna take about 15 minutes or so to talk about what's going on right now, how things are going. We're gonna take another 15 minutes right after the first break. We will talk about the fixed indexed annuities, because that's important. It's very important, especially with interest rates being so low and not likely to be going up anytime real soon. Now, they could. I just don't think it's all that likely. And I think the likelihood, and we'll talk about that. So the last section of today's program, I'm going to try to carry this format going forward. The last 15 minutes, we're going to talk about individual stocks, because I've gotten a lot of requests for that. And yes, I still do them. In fact, it's actually the most fun part of the portfolio to manage. It also makes your hair fall out, but or it can if you're not, especially if you're not doing it right. But if you just keep cool heads, we're going to talk about that. And I got some news. So right now, actually, this kind of ties in with the first 15 minutes. We're talking about the economy. I'm reading, the Economist magazine, which is pretty good. I'm not sure which side of the fence they're on, because they report from economies all over the world. So I don't know if they're conservative, liberal. They seem to have a little bit of both. And I have to admit, my favorite readings are Scientific American, Popular Science, that sort of thing. You'll see stuff come up in those magazines that won't be here for a while, like fusion for electricity. Boy, when they get that done, man, it changes everything. I mean, absolutely everything. So, and maybe next week we'll talk about that. But anyway, what I wanted to talk about a little bit this week was there were some articles in there about the office space and how office space, has been hurt because people are now working from home. They're thinking about not coming back into work. I don't know that that's going to be anywhere near. And then, quite honestly, that's what they're saying too. They don't know that it'll be near as much as people think it is, because a lot of people enjoy going to work. I hate working from home. I mean, I don't like it. I'd rather get up, go into the office. Now, I like to have the option if I don't feel that well. Sometimes it's a lot easier just to stay there and work from home. And by the way, I can work from my laptop because I've got this really expensive laptop, and it's got all kinds of software and, in there to protect my privacy and all that other good stuff. And literally, I mean, you can run anything I could do. Actually, that computer is about maybe 1,000 times more powerful than the best computers they had when they launched the first man to the moon. And, talk about bravery. Those guys were brave. Actually, I think they just didn't know. But anyway, so that's not going to change. Another thing that's not going to change is population growth. That's not going to change. Population worldwide is still growing. Okay, so anyway, it'd be really interesting to see what happens. I probably would shy away from real estate investment trusts at this point in time. I know they're part of the indexes that I'm holding in a lot of the funds I hold, and they're going to be a permanent part of that, and that's okay because it's just relatively small. It's not a huge allocation, and I don't think that I would be loading up on that in any portfolios. We're not doing that. So real estate investment trusts, if you get a good one and it's in the right space, maybe it bucks the trend and does a whole lot better, and there's an awful lot of risk to that as well. So I would kind of shy away from those right now. And again, if you're in a diversified portfolio, the S&P 500, for that matter, has several REITs in it. So most funds that you have that have dividends will have REITs in them, real estate investment trusts. So you've probably got more invested in real estate than you even realize. And if you're interested in finding out, you can always hit me up because we have this tool that will take all of your funds and we can put the funds in there. And this is done for people who are looking for advisors, by the way. I couldn't do this for the entire population because I'd never get any real work done. But if you're looking around and you'd like to see, you just want an opinion on your portfolio, we'd be glad to do that. Anybody that's looking around for whatever reason. And I'll tell you what, the vast majority of the time, the reasons are advisor retired. We're hearing that a whole lot more today because my industry is actually kind of old. They're older. So they retire fairly frequently. So we hear a lot about that. People move across the country or they switch jobs and, they prefer to have their 401k in their own IRA because there are no restrictions on how you can invest that instead of just an IRA, the 401k plan. Those are all fine. So if you're in one of those situations, you want to see what's in your portfolio now, what we would recommend, we'd be glad to do that for you. Okay, so if you're actually out there seeking, and by the way, if you call or leave a message or go to my website and leave us an email message, it's pretty difficult for us to call back all the people that want to talk to us. So we will not hound you. We don't have time for that. What you see is what you get, I guess. And I just try to be the advisor that I would like to have. Make sure you ask the right questions. How do you know if they're the right questions? Well, I have some ideas on that topic too. We'll probably talk about that on a future radio show. And then find somebody that you just feel comfortable with. That's the number one thing. Investing well is feeling comfortable. When you're talking about things like the economy, like a lot of businesses, there's a lot of commercial real estate that's going empty because they sent people home and they're not going to bring them back. Well, that can be kind of scary. A lot of times it's overstated. And then the reactions are higher than they should be. So at some point in time, the real estate investment trust may actually make a really attractive investment. I think it's probably a little bit too early on most of them. Not all of them, but most of them. And so anyway, that's what it was kind of looking at there. And then I was reading some of the stuff about how China and America, two top economies in the world, what they're doing, how the Europeans kind of fell behind a little bit, and what might be happening in the future. And all that speculation, by the way, because nobody really knows for sure. I think there was an old joke when I was, and this is really old. The It's so old that I've actually forgotten it. I'm just kidding. But if you want to get multiple opinions that never agree, just ask an economist what they think. So anyway, I didn't say it was a good joke. Oh, that was a kind of a crazy noise. Oh, somebody left their phone in here. Oh, that is funny. So anyway, by the way, if you have a question, you can always reach me at bill@bullingtoncapital.com. And again, I was just going through Economist Magazine, looking at the results on real estate investment trusts, and it doesn't look like it's as bad in a lot of areas as people are thinking it is. So that's pretty good. That's really good. The magazine goes through talking about stuff that's going on worldwide. So that's one of the reasons I kind of like that magazine. It gives you an opportunity to see what's going on outside of just the United States. A lot of times people forget how interconnected the economies are. I'll tell you who doesn't forget is Google. Google doesn't forget. Neither does Alibaba. Neither does Amazon. And today it's amazing when you look at the S&P 500. Okay, what's the S&P 500? Those are the largest 500 companies by size. They call that capitalization. The largest 500 companies by size in the United States. And you look at the revenues that are generated in that, and I think it's over 50% that are of the revenues from the top 500 companies in the United States are generated outside of the United States. So it's been a global economy for an incredibly long time period. What goes on here has a tendency to affect the rest of the worldwide economies big time because half the revenues that we're generating are coming from overseas. So if they start cutting back on spending, it's not just us. And that's one of the reasons that you see stock markets around the world that are pretty highly correlated, much more so. It's actually been more and more highly correlated if you go over the years. There's actually a trend where the markets are more highly correlated than they have been. If you were, say, looking at the 80s or the 70s, 60s, 50s, the correlation there was not significant. Let's put it that way. Today, they are moving in generally the same overall directions, different speeds, that's for sure. But when one of the big boys is going down, it creates trouble in the other indexes. So the vast majority of the country funds tend to move somewhat together. There's still a benefit to diversification, by the way, because it's not they're not all moving at the same time, the same way. So there is still value in diversification. It's just not as valuable, I think, as it once was, because you're getting so many of them that are moving, more similarly than they ever have. So, and the good news is that, if you look at large company stocks in the United States, if you take out the top 50 stocks from the S&P 500, the valuation drops fairly low. Lower, I should say, not fairly low. But when you start looking at valuations in other indexes, mid cap, small cap, and you start looking at their growth rates, all of which have been very good, it looks like a really good thing. It looks fine, especially if you have a 10-year time horizon. If you don't have a 10-year time horizon, you should not have all your money in stocks. Actually, somebody with a 10-year time horizon probably shouldn't have all their money in stocks. More often than not, everybody's a little bit different, okay? But the average investor out there who doesn't have a 10-year time period where they're not going to have to touch the money, well, you shouldn't have all your money in stocks. I got a quick call here I got to take. If you'd like to call in, the number is 216-901-0945. And is this Adam, my buddy Adam, or is this a new Adam?
No, this is your buddy, Adam. How you doing, Bill?
How are you doing?
I'm doing great. Once again, I enjoy your show. It's great to be listening to you all these years. Just had a couple of quick questions.
Sure.
The first one was if you had any seminars coming up
We haven't.
Motion on that?
We haven't yet. We haven't scheduled it. We will have them coming up. And interesting, I started talking about real estate right off the bat for today's show, mainly because I'll just bring this up since I'm talking to you. They're forcing me to move.
Oh, geez.
I belong to we rent our space from a big a company that owns a lot of real estate, a lot of buildings. And interestingly enough, a brokerage firm that's right next to me wants my space, and I guess they bought it out. You know, they paid enough that they're going to have me move to one of their other buildings. And so I'll be moving, and I'm not sure. I think I know where the space is. There's a pretty good chance that it's going to be just down the road a little bit in the same business building development.
Okay.
And this one has a really nice meeting room. So immediately when I saw that, I thought, oh, I got to call Adam. So I'm glad you called me. Because this would be great for the investment club. It holds about 40 people, which is I think should be okay for you guys, shouldn't it?
Yeah, we've got about a dozen members. We've just been meeting at Panera and doing, after the Zoom meetings, we decided a couple months ago to meet at Panera, and so far it's been working out. We have our own meeting room, and we got to spend $50 in food and drink first to use the room for free.
Well, I'll tell you what, when if we end up going to this place, and nobody will have to spend anything because it's included in my rent. So that should be pretty good. And here we are telling all of my personal business on the on the radio. But yeah, it's got a couple really nice meeting areas in the building. So I'm optimistic about that. I don't know yet because I was just told that we got to move. They're not renewing my lease at the end of next year. That we got to get ready to go. And then they offered up this space. So I like it. It would be really nice, I think, to be there because it does have more meeting facilities and could facilitate stuff like that. You know, that would be a lot. I really enjoy that kind of thing. So, how's your club doing?
Great. You know, we transferred from.
Oh, I just lost
consumed with so many orders.
Hey, Adam, we lost you for a second there. Yeah. Hey, can you hang on? I got to take a real quick commercial break.
Sure, of course.
Thanks. You're listening to Bill Bullington right here on 1420. Stay tuned because I'll be right back.
For the joy of the Lord is our strength. We bow down and worship Him now.
And we're back. You're listening to Bill Bullington right here on 1420. I'm here every Saturday morning from 11 to noon. If you hear anything that you'd like more information on, feel free to go to my website, bullingtoncapital.com. You can sign up or ask me a question. It's really funny. A lot of people go there and then they forget to fill out the question. So, feel free to reach out that way. And Adam, you still there?
Yes, I am.
That's good. So you have to remind me, where did I leave off?
Okay, we were just briefly talking about your scheduled move, and then I wanted to ask you another question about a stock real quickly.
Sure. All right.
I've owned BG Foods for a couple of years, and the dividend's been sustainable. Right now it yields about 6%. Is there any number that you would have in mind where the dividend becomes risky or not sustainable?
Yeah, that is a tough question because there are so many things. I mean, there are literally thousands of events that could occur that would affect that, the answer to that question. And that's not an exaggeration. I mean, it's just unbelievable. You know, that's businesses. I mean, who would have predicted a pandemic? You know, there are just so many things that can happen in any business. And I know BG Foods very well. It comes up on my scans fairly frequently. And I've been following them for a long time. Reason I don't own them personally is because I checked they're in a couple of the funds that I own, and so I don't want to overweight it too much. And it's in there, and I like the company. I think it's a good company. I think it's been well run over the years. Everybody has their ups and downs. That's just the nature of business. But if they're not covering, and I'll go back and take a look. I don't have my computer here today. If I'll go back and look at it, if they're paying out more than they're earning, or if they're paying out more than, say, 70 or 80%, and their earnings are, and that becomes a habit, eventually that's not going to be sustainable. I mean, for most companies. And if you're a REIT or a limited partnership, it's different. They have different rules for that. But for your publicly held companies, C corps, they typically, if they're paying out more than 70% of their earnings, and they're doing that 2-3 years in a row, that's not a good sign. So, okay. I shouldn't say that. It's a flag that you want to check into. And so if you just tag me up on an email there, and I'll check it out and get back to you.
Okay. Great. Okay, well, thanks for your time, and I'll look forward to talking to you very soon.
Okay, thanks. Have a good one. Have
a great weekend.
You too.
All right, bye.
And I got Jerry. I haven't talked to you for a while.
It's been a...
Oh, you must be on your cell phone. We lost your call. Just got dropped. Can't.
I'm here. Are you there, Bill?
Yeah, I'm here.
Okay. You have been a proponent of ETFs and funds, and I'm starting to look at them myself. I have a question. What do you think of the Carl Icahn Fund? It's currently paying close to 15%. Has about mid-range as far as where it's been selling throughout the year. It's got a asset value of about $16 billion. Just curious.
Well, if you look at Icahn's long-term track record, it's very good. See what he does. He's a value guy. He tries to go in and find things that other people are overlooking. And so if he thinks there's a dislocation in the market somewhere in a company, the dislocation, by that I mean the share price should be much more higher than the current share price is selling for. Mm-hmm. And he has a tendency to load up on those, and it's great when he's doing well, and not so much when he's not.
Of course.
So it's really volatile. I mean, when you invest that way, you're going to put up with enormous volatility. So the average person, I'd say, probably not much more than 4 to 5% of your investment accounts. And just get ready, grit your teeth. You're going to get, it's going to be pretty a volatile ride. But he's had a really good long-term track record, and I don't know how old that guy is though. He's got
85.
Oh wow. Well, that might make me a little.
Well, I would hope that he has backup.
Yeah.
But I just was curious because the first thing in investing that the 15% dividend, it smacks of why is it at that rate? Why it's just
there are no conservative investments paying 15%.
Of course not.
There are none. So that's that has to tell you something right away. You want to look into the holdings, the current holdings. You can go to the SEC's website and pull that up, by the way. And
right, I have. I was just doing that. That's why I said it came up on the screen, and I'm saying, let's see what Professor Bullington says about that, because it does seem to be fairly well diversified, and you can't argue with a guy's track record yet. Like any one, I got involved with T. Boone Pickens. I think it was Mesa Petroleum, and it was going well until they had the 10-for-1 roll up, and things went south real quick.
Oh yeah, that's the thing about all companies, and this is one of the things that really impressed me with Jeff Bezos. He's the CEO of Amazon. He founded and started the company. The guy's a true genius. And I'm watching what he's saying one day, and he goes, one day Amazon's going to go out of business. And I was going, I was like, wow, I can't believe he's telling the truth. Because he knows, as well as anybody, he's studied the history of stocks. No company stays on top forever. They never do. Ever.
Sure.
Okay? That's somebody told me once a long time ago, never say always and never say never. Well, always is not ever. But
right.
But the bottom line is, at some point in time, computers are going to be so fast. They're going to process so quickly. And FedEx, UPS, they still reinvest billions of dollars, and now Amazon will probably at some point in time compete with them. As far as I know, they're not competing yet. They haven't opened up to the general public for Amazon shipping, but I can see that happening at some point in time. But what he's saying is that at some point in time, the computers will be so fast, and you're just going to ship directly from the factory floor, and it's not going to go to a warehouse. These guys will be having their own warehouses. You'll be buying directly from the manufacturer online.
Fewer touches means more profitability.
Yeah. And so that's what he was alluding to. But that day's not today. That might take 30 years to get to that point. So in the meantime, he still holds, I think he's still the single largest shareholder in Amazon stock, but because it's not today. But I was just amazed at the candor that he would literally come up and say, one of these days. And I just went, wow. Yeah, that's pretty good. He probably had puts on the stock when I'm just kidding. But he wouldn't do that. He's way too smart for that. But anyway, so.
Right. Do you have any input as far as options trading? You ever have a seminar on that or not?
No, it's, what? So many people get burned so badly by that that it's really not a useful thing to do. It takes a long time to get just the basics. What is a fair options price? Well, fair is, you get to define that, and it's so hard, Jerry, and so many people lose so much that I find it really difficult to recommend that. That's one of the reasons that the fixed indexed annuities are so popular, because they have guaranteed rates that are higher than most people have averaged in their stock portfolios. And you have the chance, I'm not going to tell you the investments, and if you listen to any show where I've ever talked about this, the investments in there, there's some pretty good ones, but the chances of those investments outperforming the fixed guarantees are pretty low. They're pretty low, especially when an investor gets involved, because the average investor makes decisions completely emotionally, or at least 90% emotionally.
Sure.
And then they have a tendency to bail at the wrong times. And so I think that the chances of anybody beating that fixed or that guaranteed portion are nearly zero. And I have a bunch of it myself. So, because
I would ask the question. Let's take a hypothesis. Say General Motors is at $60. That's fairly close. Well, if a person would if the person would be happy to buy General Motors at $60 a share, why should they not be interested in selling a cash secured put at say $60 and collect a premium?
Because if you sell a put, okay, the worst thing that can happen is it goes to zero and you lose 100% of the value.
Of course.
Okay.
Yes.
So that's a horrible idea for the average investor. The average investor got lost when you said sell a put. So
I understand that, Bill. But
you're talking about 0.1% of the population that would be able to pull that off, including the professionals.
If a person does not sell a put during the earnings period, it certainly reduces the significance of it by a fair amount.
No, not a fair amount. It's a very small amount. You have not. No, dude. I have all the data. I'm telling you, it does not react like you think it should. It doesn't.
Well, the stock is not going to tank within, a 1 month period unless it gets a bad skid on the earnings. It's highly...
Well, Jerry, all I have to tell you is that this is America, and you are free to do whatever you'd like to do, okay? Now, whether it's a good idea or not, that's a matter of opinion, and my opinion is that it's not a good idea.
All right. Well, as I said, if a person would buy GM, what's the difference of selling a put? To each their own, I guess.
Yeah, that's a very, very sophisticated move, and the likelihood of it being more profitable than just buying the stock and sitting on it for the average investor is nearly zero. I mean, could it happen? Yeah, it could happen. Should it happen? It actually should happen. If you look at the numbers, the implied volatility and all that stuff, you should be able to collect that premium, and you probably won't have to. You'll probably come out a little bit ahead, but there's that one, they call the outlier. When the outlier shows up, it ruins everything.
Right.
So anyway,
but okay. Well, I appreciate your. So you're, as I said, it's a more conservative tack to not do it, but nonetheless, there is money to be made if you are willing to accept the risk.
Yeah, that's absolutely true. If you're willing to accept the risk, and the risk is high, okay. So if you're willing to accept that risk, then you could make a little bit more money. Long run, short slide. That's my opinion of it.
Well, risk management is what it's all about. That's all
absolutely. Yeah.
Okay.
For sure.
Thank you, Bill.
All right.
Have a good day.
Have a good weekend. Yeah. Sorry. When I hear something like that, I used to hold the options principles license. 1 in 1,000 people that do what I do for a living ever decide to sit for that test because it's hard. And I didn't want to get involved in anything unless I knew about it and knew a lot about it. And it was a long time ago. And what I learned was that most options techniques you don't want to use. They're very difficult. You want to leave those to the professionals. Now, they're professional hedgers that do very well with that kind of stuff. And that's kind of what he was talking about, actually. It's something that a professional hedger might do. That's exactly what those fixed index annuities do. They don't put the money at risk. They actually buy options on the index. And they're professionals. By the way, they get better pricing than we do. That's one of the reasons that they will make more money in more often than not doing that than an individual investor will, is because they actually get better pricing. They pay less for the transactions costs, and they pay less in a lot of cases for the actual option itself. So, and I meant to talk about this because interest rates are so low, and we were talking about the economy a little bit earlier and how some REITs may end up doing well. Boy, that's something that's another area what I wouldn't recommend for novice investors or somebody who's not a full-time professional to get involved in. I think that right now the rates of return that you can get by using fixed index annuities, and there are more than one company I happen to like nationwide. And if you want to know more about that, please feel free to write me, hit me up. I'll send you a link. And this is what I would do. Here's what I would do for the average person. This is what I do when people come into the office. I go to the website, we look up your age, look up the amount of money that you're thinking about, and it shows you a schedule of what the potential payouts are. Now, I will send you the link to that. No sweat. You want to see what that could be? There's no pressure there. I'm not even there. So if you get there and you have trouble figuring out, which almost nobody does, by the way, but I could see it happening. Because there's a couple things on there that are a little bit confusing. You have to just read the website just a little bit, but you can put your age in there, you can put the amount of money in there, and it'll show you the type of income that you could generate. And when you look at that, I really believe it's going to be hard for the stock market to keep up with that. So I'm going to leave that topic alone. And we're going to a commercial break. This is Bill Bullington right here on 1420. Stay tuned because I'll be right back.
Gotta keep
Welcome back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also go to my website, bullingtoncapital.com, if you have a question you would like to reach out. And I promise I won't bite your head off. I feel bad for some people, and they call in, and they don't realize what they're doing. They're literally trying to manipulate me to give them the answer that they want to hear. And I really like all the callers that have been around for a lunch, and I feel bad for them because I just kind of feel like I hammer them too hard. But it's out of concern. It's really out of concern, because when you're talking about some pretty exotic options transactions, that can go really south really quickly, and I really don't like to see that happen. So anyway, just looking out and just trying. And, I do some stuff that would be considered aggressive. Actually, it's very aggressive. In fact, the Look Out for the Bull website publishes a list that I pick stocks from and I manage real money with. It's only a small portion of my money. That's like 25%. 75% of my money is in the same stuff that I put my clients in. Now, they have different percentages than I do, but it's the same because I have to be able to watch it. And if everybody was different, I wouldn't be able to watch it all. So anyway, that's basically what we do. We help people with that portion. I have a guy who's what do they call that? The guy that's got like the unenrolled agent. So I have an enrolled agent on retainer. Anybody has tax questions, this guy's really nice, easy to work with. I have estate planning attorneys that we've worked with over the years. You have issues with that stuff. And it's kind of interesting because people do send me that stuff. Can you take a look at this trust? And well, actually, I can. I'm not allowed to give you advice on that. My errors and omissions insurance is not for law. It's for investment advice. And I can look at it, but I can also point you in the direction of somebody that you would be comfortable talking to. And I'm going to try to get some of these guys to come in, or at least, show up on the phone later this fall, because it's important, and it's really important. And I can't tell you how many times I see people just so distraught. Somebody dies unexpectedly. Well, that's hard enough. And then they come in and they didn't have a decent financial plan. Wow. It is a lot of work. And you better not mess it up. They're not very forgiving. So anyway, we got, after you've been doing this for as long as I have, you've seen just about everything, actually. I don't have a billionaire client, by the way. If I did, it would be my only client. But I have a lot of people that have done very well, and a lot of people are going to be there. No doubt in my mind they're going to be there, and at some point in time. And hopefully we just don't, if you can avoid the really big mistakes, that's really where it all comes to. And Jerry put it very nicely. You manage the risk. Yes, that's what we're doing. In order to manage the risk, you have to recognize the risk. Where is the risk? Where's the risk in your portfolio? One of the reasons I've been using those fixed indexed annuities is that bonds are almost guaranteed to have negative returns over the next 5 to 10 years. Now, why would I say that? Well, first of all, they're only paying around 1%. And when interest rates go up, bond prices go down. And interest rates are so low right now. How much lower? I guess they could start charging us to keep our money in the bank. They do that in Europe. But that's still not a lot. That doesn't give current bonds a big boost. And if interest rates ever do start to go up, and I don't think that's going to happen for a very long time, but if you look at bond interest rates now and you look at the inflation rate, there's a negative real return today. So that's one of the reasons that I brought back, or actually brought into my mix, the fixed indexed annuities, because I think they fill a gap there. I think they're going to give a really decent return. And in fact, I'm pretty sure they're going to do better than a whole lot of people are going to do in their stock investments. So there are lots of reasons for that. I'll cover this, every week on the show, the second segment. And now I'm just going to drop it for a little bit. But again, if you want to put your age in there and the amount of money you got, and it'll show you a schedule of what you could withdraw from that. Okay, and that's just the withdrawal rate. That's the fixed portion of the investment. Next week, we'll talk about the variable portion of the investment. That's the investments themselves. And there is another one, incidentally, that has no sales charge in or out, doesn't have a penalty. It's got a rider that you can add to it. So it's voluntary. If you want a 4% income and you're an individual, you can guarantee that you'll get a 4% income based on what you start with. It can go up. That's one of the big differences between that and the others. It can go up. So if your investments go up, that guarantee goes up. Your income goes up, but it won't go down. And if you decided that 3 or 4 years after you're into it that you just wanted to chuck it, you could do that too. So there's no cost on that one. And it's got all the big mutual fund companies in it. Vanguard, Fidelity, T. Rowe Price, you name it, it's in there. Has a lower guaranteed income because it has the opportunity to go up. The other one has a higher guaranteed income, but it's fixed. Okay, so I've gone over my time on that for this. So I'm going to get to this individual stocks that people really want to hear about. Well, actually, some people really want to hear about. And it's kind of where I spend a lot of time here. I'm working on a couple things to bring out over the next few months, so stay tuned. Mike Seeger's publishing the Look Out for the Bull list every day. That's the list that I'm choosing the stocks that I'm investing in from. And he does these scans. I showed him how to write the scans, how to run the software, and he does a good job of publishing that every day. That's lookoutforthebull.com. I think it's $10 a month. And that list is where actually the stocks will come up on those lists multiple times. When you see a stock that's run a really long way in a fairly short time period, it's come up on that list more than once. And that's one of the things I like about it is if you miss it the first time, well, guess what? It'll show up again, more than likely. In fact, most of the time it shows up 2 or 3 or 4 times on its way up. So if you miss the first, second, or third time, you might even still catch it on the 4th time. And that's pretty good. But I'm going to tell you this. It's not easy. Simple is not the same thing as easy. And I keep coming back to the golf club or a golf swing. It's pretty simple to hit a golf ball a couple hundred yards. You just swing really hard. Make sure the club head is flat when you hit the ball. Now go out and try to do that. Little different when you're actually trying to swing the club, but it'll work if the club head is flat. Now, fortunately, managing a stock portfolio is not as difficult as hitting a golf ball straight for over 200 yards. It's not. If you get the right information and if you remember to follow it, you're just following the instructions. It's highly emotional, and you'll know what I mean when you try it. But I'm gonna quit trying to scare you right now. I wasn't really trying to scare you. I'm just trying to set you up for what you're going to see. And here's what I like to see. Okay, so out of that list that's being published every day, and Look Out for the Bull, I'm going through the same list everybody else is, and there are other things that I'm looking for. What are they? Well, by the way, don't drive off the highway trying to write this down, because you can get this on my website. The podcast is there. It's on iHeartRadio, and you can always call me. Okay. So here are the things that I like to look for. I like to see that the stock that day has closed, its closing price is in the top 25% of that day's range. I want it closing near its high of the day. Why? Because I'm interested in stocks that are on the move right now. And a stock that closes in the top 25% of that day's range has been moving up. Okay. So that's not the only qualification, by the way. But, if I saw a stock that opened at, let's say it opened at $20 and it got to 22, and then it comes all the way back down and closes at $20.25, I'm like, all right, well, there's a pattern for that in the Japanese candlesticks that's not real good. So I'm going to avoid that. Japanese candlesticks, I know you probably don't know what that means, but it's just a way of looking at price movement and trying to interpret where you think it might go. And a lot of it's superstitious, by the way. But a ton of it is superstitious. In fact, I'm superstitious. I have the reason I like to see them close in that top 25% of that day's range is because I've always done better with those types of patterns than I have other patterns. It's not the only pattern that works. I mean, there are tons of them that work. In fact, that pattern that I just talked about actually works about 50% of the time, which is really good. That's actually 50% is not bad at all. Especially if you cut your losses really quickly, then 50% can make you really wealthy. But, and that's part of this whole process. When you're looking at individual stocks, when you have that portion of the portfolio, you say, look, I really want to do this. And by the way, for the people that I was just talking about, the fixed index annuity, that is the opposite end of the spectrum. That's the really conservative side. And this is the really aggressive side that we'll have to cover in more detail next week. As I hear the radio. Feel free to reach out to me anytime. You've been listening to Bill Bullington here every Saturday morning from 11 to noon. Also go to my website, bullingtoncapital.com. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.